Good evening, I'm Alessio, and tonight we're turning our focus to a company at the heart of connectivity, entertainment, and shifting consumer habits, Charter Communications, which operates under the Spectrum brand and has just released its Q3 2025 results. What we're seeing is a textbook case of digital disruption meeting structural pressure, declining subscriber bases, rising capital requirements, and an uncertain strategy in a rapidly changing telecom world. Charter reported total third-quarter revenue of approximately $13.7 billion, down about 0.9% year-over-year. Charter Communications' net income attributable to shareholders came in at roughly $1.1 billion, down around 11.2% from the prior year. Charter Communications' adjusted EBITDA fell about 1.5% to $5.56 billion. Charter Communications, that paints one side of the story. The top line is shrinking, margins are under pressure, and the capital demands remain bullish. A deeper dive into the operating metrics reveals the core challenge. Charter's residential and small business customer relationships slipped by about 2.1% in the quarter, bringing the total to roughly 31.1 million. Charter Communications' total internet customers declined by about 109,000 in the quarter to 29.79 million. Charter Communications' video customers fell by roughly 70,000 in the quarter, though that was an improvement over the prior year's decline of 294,000. The Hollywood Reporter. In short, subscriber attrition is down but still persistent, and the connectivity business is no longer immune. What's driving the subscriber bleed? Several factors converge: intensifying competition from fiber optic providers, fixed wireless alternatives for mobile carriers, and changing consumer behavior favoring streaming over traditional pay TV bundles. In Charter's segment reporting, connectivity revenue, Internet plus mobile, grew modestly by 3.8% year-over-year, driven by Internet revenue growth of 1.7% and mobile service revenue growth of 19.2%. Charter Communications. But the growth in mobile and Internet wasn't enough to fully offset declining video and voice segments, which dropped 9.3% and 7.9% respectively. Charter Communications. From a finance and strategic outlook, several dynamics stand out. First, churn in core residential segments remains a drag. Even if the pace of losses slows, the base is large and the competition is fierce. Second, the capital spend is rising. Charter's capex for the quarter was about $3.1 billion, up 19% year-over-year. Charter Communications. That means deployment of network upgrades, broadband extensions, and mobile infrastructure continues to consume cash. Third, the debt load looms large. Charter had about $95 billion in principal debt as of September 30, 2025, with only about $464 million in cash on hand. Charter Communications. For investors, creators, and analysts in business and finance, this is a pivotal moment. The telecom model that once centered on bundled video, phone, and internet is shifting. Charter's results suggest that the fight for broadband dominance matters more than ever, but broadband alone may not deliver the growth and margin expansion previously assumed. The incremental mobile growth is a positive signal, yet scaling it further, monetizing it adequately, and converting mobile lines into higher-yield services is today's challenge. Another key layer: the content ecosystem. Charter's inclusion of streaming apps in its packages, such as ad-supported Disney+, Hulu, HBO Max, and others, signals that the company is adapting its video strategy. But that approach also raises questions about margin impact, brand differentiation, and whether consumers will pay for bundled services in a streaming-first era. Looking ahead, there are important watch points. 1. How will churn trends evolve? If losses in Internet or mobile accelerate, the base revenue risk becomes material. 2. How will Charter invest to convert connectivity into converged services, Internet plus mobile plus value added? 3. What will be the margin impact of bundling streaming apps and whether that improves retention or just drives cost? 4. How will Charter manage its debt and capital spend burden in a world where free cash flow growth is under pressure? In my view, Charter's Q3 results reflect a business in transition, not failing, but evolving under pressure. The network backbone and scale remain formidable assets. However, the model of growth through neighborhood video subscriptions is obsolete. Charter needs to lean harder into higher growth segments, mobile, converged services, and value-added offerings, while managing capital intensity and debt risk. For content creators reporting on telecom or investors allocating to connectivity, this narrative is rich. Legacy revenue erosion, growth in adjacencies, balance sheet discipline, and execution risk all in one story. So tonight, when you consider Charter's numbers, remember this: the headline subscriber losses are large, but the deeper question is whether the company can pivot fast enough to a future where internet and mobile are not just replacement services but margin engines. I'm Alessio, and that's your business and finance update for this evening. Stay alert, stay informed, and keep your eye on how connectivity companies are navigating the convergence of bandwidth, mobile, and consumer behavior.